Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together, we want to make the best investments that we can, so thank you so much for joining us. And on today's show, we have Lawrence Fuller, and Lawrence has been investing since the early 1990s, has plenty of battle scars from the tech bubble. Those scars set him up to weather the Great Recession a bit better, and both of these events have him growing increasingly cautious today. In this interview, we're going to discuss some recent work from Lawrence, where he cites the current caution of Jeffrey Gundlach, Bill Gross, Stanley Druckenmiller, Jeremy Grantham, George Soros, and Carl Icahn, to name a few. So we're going to talk a lot about his current outlook on the markets right now and how he's responding and what he thinks and why. So I hope you'll enjoy today's interview with Lawrence Fuller. Remember, our goal is to help you learn to invest financially and in all of life. You can always find more at investorinthefamily.com. How much time do you currently spend trying to figure out your investments? Are you tired of spinning your wheels, attempting to conduct research that you really don't have time for, and if we're honest, you might not actually be qualified to do? Brett Jensen is the man behind the Biotech Forum, the #2 premium marketplace service on Seeking Alpha. He's also a top 5% ranked analyst according to TipRanks. Do you like owning companies that get acquired? So does Brett. Are you anxious about the current election season and how it may impact your portfolio? Perhaps it's time you put a portion of your portfolio on autopilot with Brett as your guide. Visit biotechforumsa.com for more information. That's biotechforumsa.com. SA as in Seeking Alpha, biotechforumsa.com. Well, hey, Lawrence, welcome to the show.
Thanks for having me.
Absolutely. Well, I appreciate you giving us some of your time this afternoon. And to kick things off, do you mind giving us a little bit of your background as an investor and what you're doing today?
Sure. Well, I've been an investor. Well, I started out in the early 90s, 93 as a stockbroker at Merrill Lynch. I guess they call them financial consultants. And I spent the remainder of the 90s going from Merrill Lynch over to the bank side for a little while when the banks got involved in investing with First Union, which is now Wells Fargo, then back to Morgan Stanley for the tech boom, which led to the tech bust. And so that's how I learned about investing in my 20s. Made a lot of money, lost a lot of money. I guess I learned quite a few things. And then in the 2000s, I sort of gradually moved more and more towards becoming an independent. I was eventually starting my own firm in 2005, about 10 years ago, which is where I am now as an independent fee-based advisor. So sort of my evolution, I think, through that whole process was starting out as a stock jock and just looking at stocks from the bottom up and not really understanding the economy or how markets work. And then going through what we went through in 2000 and in 2008, it becoming much more of a macro top-down analyst of the economy and the markets and what's going on, which is what I typically write about on Seeking Alpha. And my approach, as far as portfolio management goes, I'd probably call it a tactical approach is the best way to describe it, because what I'm doing is instead of looking at a portfolio and determining what percentage I'm going to have in stocks or bonds or cash, a tactical approach just basically varies the ranges that you're going to have. So I might have an upper end of exposure for an asset class like equities. It might be 50%, and I won't exceed that. I'll reach that when I'm at my most optimistic point. But then as I become more conservative or more defensive, I might lower that exposure down to let's say 30% or 20%. And it really depends on how much risk I'm taking and what my return objectives are. So, and I do that for each asset class. So that's more along, that's a sort of simplistic approach to a tactical portfolio management strategy. Yeah.
No, that's great. And I think it'd be fun to maybe I'd love to dive into that more. And I think it'd be fun to do that maybe when we get another chance together. Today, you and I talked about specifically a couple of articles you've written recently that have been on Seeking Alpha. The first one titled "Sell Everything!" that, you know, obviously stirred up a lot of engagement on that article. And then you recently wrote a companion article, I'm assuming companion, Buy Everything. And so I would love, if you don't mind, I don't want to dive deeper.
Neither of which is a tactical approach. So, yes.
Awesome. More fodder for dialogue. So let's do this. I would love, if you don't mind, let's start with the Sell Everything article. And I'd love for you to briefly walk us through your thesis of that, and then we'll talk about it a little bit.
Well, it's interesting because, you know, sometimes obviously there's a lot of feedback when I wrote that. And I really the title more or less came from a comment that was made by Jeffrey Gundlach in days or weeks prior. And it wasn't really a recommendation by me or him or anyone else to sell everything you own. It was more or less an expression of frustration with where we are today in terms of monetary policy. It's going to probably, you know, everything's going to come back to the Fed for me. In a sense, just how mispriced assets are today. And I think what Jeff Gundlach was saying was that, you know, bonds are mispriced, stocks are mispriced, everything is mispriced. So just sell everything. Now that's not what anyone's going to do, and I'm certainly not doing that. But that's what I was trying to express, was this frustration with asset prices and how dislocated they are from the fundamentals we see in the marketplace, as well as the developments we see in the real economy.
At the beginning of the article, you immediately referenced Jeffrey Gundlach, but then you also mentioned Bill Gross, Stanley Druckenmiller, George Soros, Jeremy Grantham. I mean, those are some, Carl Icahn.
There's a lot of them.
Those are the biggest hitters, or the big hitters out there. Do you?
Absolutely.
So I'd love to hear, what are the big messages? You mentioned Gundlach. Are all these guys in that same camp? Is there some varied approaches they're sharing?
I'm sure there's, I mean, you know, I think they all have different approaches. They all have different investment styles. I mean, you have, very, very long-term oriented investors like a Jeremy Grantham. And then you have, investors like Soros who have said that they're short or buying puts on the S&P, which would be much more of a shorter term, tactic. And obviously Gundlach is a fixed income investor, primarily a bond investor. So, but I think that what they, you know, that the common theme is that this, you know, I'm going to call it monetary policy lunacy, if you don't mind, of having 0% interest rates, or negative interest rates for that matter elsewhere, creates these distortions. And, you know, what I've seen, and, you know, I try not to fall victim to it, but it's almost hard not to do, is that the money markets of 10 years ago are the junk bond yields of today. So if you're trying to earn income, and you're forced out of that money market, which has gone from 5 to 0, you're gradually moving through, you know, down or up the food chain in terms of risk, where you're forced into a treasury bond, and then the corporate bond, and then eventually a junk bond, onto some stocks that have dividends, higher dividends and higher dividends. And so you continue to be forced to move up the risk pyramid to earn that same yield. In many cases, even a lower yield. So in some cases, you're assuming a lower yield today on a very risky asset relative to what you would have found on a very, very conservative asset several years ago. And that's just that's to me is what the primary effect that monetary policy has had on markets. And I don't think it's had substantial impact on the real economy. I think that, you know, and people won't agree with me on this, but I think the economy would have healed on its own. And a lot of the things that has happened that the Fed's taken credit for would have just happened, you know, maybe it would have taken a little bit longer because monetary policy stole forward demand, but it would have happened anyway. So, you know, that's my position.
So,
and I think that's the theme. I think that's what these guys are talking about. Is that
right? Well,
how mispriced, I don't know, but you know,
like the idea of, you know, obviously the ideas you're sharing. I mean, they're not really radical by any means. I mean, they're very much. I think you could find a lot of people who have very conservative, very responsible investors who have all the same fears you mentioned. And I mean, again, you mentioned the Goliaths of the industry feel that way, which is a huge statement. What do you think about the 'cause I'm trying to think about, whenever you look back historically, of some significant negative events, whether it be political or economic, historically, hindsight's 2020, you can always go back and you can look at the years leading up to that negative event and be like, well, clearly this was happening, and it's so obvious when you can look back from a historical perspective. But in the midst of it, it's always so much harder. But right now, it doesn't seem that, it seems pretty clear. Like what you just said is pretty, it's obvious that it's so distorted, and yet we're still
you hit the nail on the head.
Yeah, we still feel this tension of, but I don't know. And that's where I stress over, wondering, because I'm in that camp, and it's
so am I.
Yeah. So tell me, like, what are you doing? How are you?
Well,
responding?
I mean, look, I think it's different for different age groups too. I think, I listen to I listen to these investors that are, and I'm not belittling them in any way, but investors in their 20s or even 30s that are sort of just got in the game after the last financial crisis we had. And they're looking at nothing. I mean, they're looking at nothing but a market that goes straight up. I felt the same way in the 90s. I mean, I was the smartest guy on the planet in 1999. And I had a much more experienced father that told me exactly what I should have been doing in 2000, nearly halfway down. And I didn't do it because I thought I was smarter than he was. But I didn't see anything then. I really, because I had not been through a cycle. I didn't know what a recession was. In 2007, I could go sit in a coffee shop with three or four older gentlemen, and maybe one of them had an income of $50,000 or $60,000, and he owned 6 homes, and he was renting them for $100 a month positive cash flow, and he put nothing down on them. They were all adjustable rate mortgages. And I had experiences like that. I thought, this is crazy.
Right.
This is nuts. But everybody's doing it, and nobody's complaining about it. And those that are considered, just, outsiders or outliers or worrywarts or, don't ruin the party sort of mentality. And, but I didn't sell my home in 2007. I could have bought it back 2 years later at half the price, but I didn't do that.
Right.
And so I think it's the same mentality with our stocks, is that, I'm looking at some of these stocks and I'm saying, wow, this is a 3% yield or a 3.8 or a 4.2. You can't really go down that far because, someone's going to step in and buy it. And the yield's just way too attractive. I think that's what we get caught up in, is we always, as you get towards the end of a cycle, we tend to look more and more bottoms up at what we own. Now, at the beginning, at the end of the crash or the financial crisis, or as we were coming out of it and it was really a great buying opportunity, everybody's looking top down. Nobody's looking bottoms up. Today, everyone's looking bottoms up, and fewer people are looking top down. And so, it should be just the opposite, it seems to me. But I'm not saying that. So I'm struggling with that because I'm looking at this 8 years from 2000, from when I started. So I had 8 years into 2000, then I had another 8 years into 2008. Here I am 8 years into 2016. And like you're saying, this is so simple. This is,
right.
All these smart guys are telling me that everything's going to go to hell in a handbasket, and, what do I do? And, so that's why 98% of what I write about is sort of be cautious, be concerned, things are overvalued. I've gotten away from saying, hey, the market's going to go down a whole lot, because I can't come up with a reason that's not fundamental why it should.
Right.
All my reasons are fundamental. I don't have that trigger event. I mean, no one knows what it's going to be, but what does seem to make a whole lot of sense is that there's going to be some sort of trigger event. Is it going to be currencies? Is it going to be who knows what that leads to, or another Fed rate increase is going to lead to some early stage of an unraveling that just keeps unraveling. And I don't know.
Yeah, it's interesting because, once QE and everything started initially got kicked off years ago, you have everyone, the fears of inflation and hyperinflation that were so prevalent for so long, and obviously have not gone away by any means, but they're not as prevalent as they were, because eventually you get tired of screaming the same thing and nothing happening. And but it's interesting because technically that argument is just as relevant now as it was then, but those voices aren't as loud anymore. And it's hard because we use terms like gold bug, and this only uses in a negative way to describe anyone who says anything good about gold. And so you're kind of like, well, I never want to say gold's a good investment, because then someone will label me as a gold bug, and no one wants to be labeled as a gold bug. And no one wants to hold cash because, cash has no yield and you're losing to inflation and all that kind of stuff. There's all these things you wrestle with, and no one knows, like you said, whatever kind of unraveling big event may happen. No one knows when that'll happen, and maybe the markets will go up 30% between now and then. But it seems like when you look at historically, well, again, it's hard because 3 years ago, we really could have been having this exact same conversation, and we would have missed out on a lot of upside in the market.
Well, and I have.
Yeah.
To be perfectly honest, I mean, I was having these conversations in 2013, coming out of 12, and I mean, the most frustrating thing for me is that, having developed some acumen for analyzing the economy and the markets, and having written 2 years ago on Seeking Alpha about the prospects for an earnings recession at a point in time when nobody on Wall Street was talking about 2 quarters of back-to-back earnings declines. Okay, having nailed that, there was no payoff. I mean, you could go back and say, well, how many other times has this happened? Well, every other time we've had an earnings recession, we've had come close to or had a significant bear market in the S&P 500, and we dodged it this time. In fact, it continues in valuation, and obviously the markets continue to go up. The pace of increases slowed down dramatically. I mean, we're up 6-7% in the last, coming around almost 2 years now, but that doesn't make a lot of sense to me. Mm-hmm. So you have to point to what's the rationale for that. I mean, not to jump over and to buy everything too quickly and sell everything, but what prompted to buy everything was that when markets are functioning properly, you see money rotating from one asset class to another. If there's fear in the market, typically you see money go into bonds, more conservative bonds, and you'll see stocks go down, and vice versa. And if you look at the way markets have been trading as of late, everything is either going up or everything is going down. It's almost as though you have cash and then you have everything else. And that's troubling, because when everything becomes very highly correlated, it's not a good sign. It's not a good sign. So there's not really any place to hide. So I sit here every day and try to figure. Actually, I just watched The Big Short for the first time.
Oh, really?
A couple of weeks ago. Yeah.
What'd you think?
And that was great. Having lived through all that and woken up with heart palpitations on Sunday evening each week before I had to go into the office. Remembering all those things was painful, but the funny thing was I saw similarities between what was going on then and what's going on now, and I was trying not to look for them, honestly. But you think about big dislocations between fundamentals and prices. In this case, it was with obviously mortgage-backed security bonds and home prices, and the fundamentals were people's income, their ability to pay. But interest rates also played a role. And then you had just huge amounts of leverage, which, we have today. All we've done today is we've just moved the leverage from one balance sheet to another. We have huge debt issues now emerging. The deficit is going to begin to rise this year for the first time. There's a huge amount, record levels of corporate debt. Pension funds are in dire straits, if you want to look at that in terms of leverage or debt that's building and outstanding because of 0% interest rates. And then you have a tremendous amount of complexity, which is, we had CDO squares. I mean, I don't think the Federal Reserve even knew what the ABX index was in 2007. There were all these terms that, you had acronyms for, and you had to understand what I couldn't understand at that time what was a CDO squared? Today I think the complexity is in our market structure. I don't think anybody knows how the markets really work. And that's because of this emergence of algorithms and computerized trading, and the fact that we really don't have any market makers out there. I mean, it's very, I think it's way beyond the Fed's ability to comprehend what's going on in markets when they don't understand how they work.
It is definitely an incredible beast, that's for sure. And when you look at all the, I mean, whether it be dark pools and intense levels of derivatives and on and on and on. Mm-hmm. I mean, to be able to track that is insane. And then it is, and you think about, and there's just a thought that I keep having that so much of that is just fake. I mean, like the derivatives, it's not fake, but it's almost like, and I don't want to use a house of cards analogy because that's kind of cheap and doesn't really get either, but it's almost like derivatives of derivatives of derivatives. It's like at some point, what is that anymore? And like what?
Well, it's not so much the derivatives, but I'll tell you one of the comments that I get from people that agree with me and that don't agree with me a lot at times is that, if the market goes down, it's going to bounce back really quick because the algos are going to step in and start buying. Now, I hear that all the time from people. And when I hear that from a lot of different people over and over again, it becomes concerning. I mean, that's really what happened if you look at the corrections we've had, the 10% around there, they didn't last but days because you saw these melt-ups in the days that followed, and you couldn't even participate in because they were overnight. The big moves in futures markets overnight, the S&P would open up 25, it would track, and maybe go up another 5 or 6 points, and then the market would close, and then it would open up the next day, another 20 points. So how does all this stuff work? I mean, I don't think most individual investors understand it because, to be very honest, I don't understand it. And I call friends that I have that work on Wall Street, and they don't understand it.
Right.
So the problem I have with the whole market structure is that if we were to go back down to 1800 again, which would be viewed as this incredible buying opportunity like it was in February, although there weren't too many people that thought it was in February. What happens if the algos don't step in, these computer programs don't step in, and they don't bid the market back up? I mean, where do we go from there?
Well, tell me this. So, if, let's say you or I have a crystal ball that says August 30th, 2017 is when X event's going to happen that's going to trigger whatever in the markets and things will unravel.
Yeah.
Two questions about that. One, if you knew for a fact it happened in a year, how would you want to position yourself now? And two, back in 07, 08, it was the mortgage-backed securities. In 2000, it was the tech bubble. I want to know what in your mind, what do you think it will be? Not the event, but what is the part of the market that you think is at the heart of everything that will cause an unraveling? Hypothetically, 1 year from now, what would you think?
Yeah, sure. First I'll tell you what I think, and then I'll tell you how I'm positioned for it. For the longest time, I thought that the stock market would decline significantly first. Money would flow into the bond market, and then the bond market would unravel. And so I thought, well, bonds are going to be a safe place to hide out, and that's one of the reasons that I'm positioned. I mean, the way I'm positioned from the tactical standpoint that I talked about initially is that I'm as underweight equities as I'm going to be. I'm as overweight fixed income or bonds as I'm going to be, as well as cash. So, cash is obviously my default when I've reduced my equity exposure. And I own gold. But I'm not somebody that stepped in here in the last 3 or 4 months and bought gold at the bottom. I've had it going back to 2013. So I've been early in the party there, and in some cases I'm still underwater. But I think that what probably happens now is the bond market, which has always been smarter than the stock market, is what unravels first, because the whole issue of whether we're 12 or 13 trillion now worth of negative yielding sovereign debt is absolutely perplexing to me. I don't know anybody that would buy a bond and assume, obviously these are all institutional investors, but assume a negative rate of return for such an extended period of time. But whether it's a rate increase by the Fed or whatever the trigger may be, when interest rates start to rise from where they are right now, even if we were to go on a 10-year, let's say from 1.5 back to 2.5, the losses for the money that's coming into these fixed income products now is going to be pretty dramatic. And, you know, I mean, I own individual bonds and I own fixed income ETFs. I own some closed-end funds, a variety of things. I think that one of the problems that's resulted from this interest rate policy is you have a lot of investors that own a lot of different investments that they haven't traditionally owned in the past, and they don't really know how they work when the environment changes. In this case, interest rates rise. And so if you start to get redemptions and you start to get selling in these ETF products and redemptions from various funds that are levered in some cases or own illiquid assets, fixed income assets, you could have a snowball effect. You could have a really significant rise in interest rates over a short period of time. And I'm not talking about the absolute change in rates, but the percentage change in rates. And that alone could create. I mean, obviously, you're going. That's the unraveling we're talking about. Is money starts coming out of fixed income, all of a sudden yields start to rise. There's higher yielding equity investments don't look as attractive anymore. You start to have profit taking in those. That's sort of the way I think things are going to happen. If I had to pick,
sure. And so you said the bond market unraveling. Do you mean corporate bond market, treasuries, everything? Or
well, I mean, the greater the risk you're taking, the greater the loss you're gonna have. I mean, if you have pension funds piling into emerging market debt now that's yielding 6%, how much are you going to lose there?
Right.
You're going to lose a lot more on a high yield bond ETF than you are on the 10-year Treasury or a corporate bond ETF. So I think it's going to be a function of duration and then the credit quality. Obviously, the longer the duration, the lower the credit quality, the greater the loss. What's going to trigger that? I don't know. I assume that so long as central banks continue to print money and buy debt, you've got them injecting that moral hazard I talked about in the article into markets where people think I can't lose. There's no way I can lose. Yeah,
I mean that's always the argument. People will complain about fundamentals, but say either, hey, well, we're the best looking option on the bad block or whatever people say, or
the best house in the bad neighborhood.
Yeah, sure. Or well, there's so much cash still on the sidelines that there's got to be more upside. Which both those, there's truth to those, but I don't want to hang my hat on either one of those. Tell me, I've read in some reputable places in the last few months or year. What was the comment? Someone made a comment about, and it was almost it was almost like a side comment. They didn't really delve into the idea very much because it wasn't the focus of their article. And they made a comment about government debt or government bonds as being one of the greatest bubbles in history. And
I think I saw the title of that.
Yeah.
Okay.
And I'm curious. There's that idea, and there's the idea of whether you say hyperinflation or just significant lack of.
That's the thing.
Do you think that do you think are those real fears to you, or in your mind is like, yeah, I see where people are coming from, but that's probably a little bit inflated?
Well, the problem is that if we get what we want, which is growth, which is inflation is a byproduct of, we're going to have this unraveling in the bond market. If we don't, we're going to turn into Japan. Which would you rather have? You see what I'm saying? I think that there's more and more rumblings about the U.S. looking more and more like Japan, or the whole developed world, for that matter, having to deal with demographic issues and the like. But I think that that's what creates that's what's so up in the air about the political election scenario. What kind of scenario are we going to have? Obviously, two different ones, whether it's Trump or Clinton. But do we get some type? Do we get some type of really big fiscal stimulus plan that should have come in concert with all the monetary stimulus and instead ended abruptly? And if we do, is that what's going to trigger growth and inflation with it, and then higher interest rates? And that sounds good, but in the short term, it's going to be bad.
Well, it makes that debt carry really difficult. And just to make sure and the audience are following that line of thinking. So basically, if we start seeing healthy or even significant economic growth, then typically inflation accompanies that. And the concern is that, well, if inflation comes with that, then interest rates will rise. And if interest rates rise, that means it's a lot more interest payments on your debt become a lot higher, and the risk of default increases significantly. That's the line of thinking, right?
Well, yeah, I wasn't thinking so much about the government debt, but I was just thinking about fixed income holdings in general. I mean, if you're look at the volume of money that individual investors are putting into fixed income products right now,
right?
At prevailing yields. So if you had, and I tend to think that there will be some sort of physical stimulus, but I don't know that it's going to be big enough. But the perception that it might be could be enough to alarm fixed income investors, and they start to shorten duration and sell. And there's a lot of people that have big profits in fixed income. So, but I sort of feel like we're damned if we do and damned if we don't.
Yeah.
In this situation, so the way I've positioned for it is I'm just accepting much lower returns. And I'm shorting my time horizons on new investments. I think this environment forces you to become more of a trader. If you're not in trading individual stocks or ETFs, and you're just sort of that buy and hold type of investor, it's very difficult. And if you're 30 and you don't have a lot invested and you're saving every year and piling money in your 401k, maybe it doesn't matter. Okay. But if let's say you're inside the next 10 years of retirement, and if you're not going to, are you going to put your faith and trust in the Federal Reserve to prevent another 2000 or 2008? And because you don't have a lot of time to run through another 10-year cycle before you retire and rebuild that nest egg. And I think that's why that's what a lot of investors are struggling with, is they're like, well, I can't lose what I have. I can't lose 25% of this. I don't have enough time to build it up again and then retire, especially at prevailing rates. That's why the Fed's policy is backfiring, is lower interest rates aren't encouraging people to borrow and spend. It's encouraging them to save even more.
Right.
Why they don't understand that, I have no idea.
Well, yeah, I think a lot of it, my assumption from the outside looking in is, unfortunately, we're going to have to cut this off in just a minute for time's sake, but maybe we'll be able to pick it up again another time. That'd be a lot of fun.
Sure.
But it definitely feels it's the Band-Aid type idea where like you mentioned early on in this conversation, that if the government, central banks would have just allowed the recession to have worked itself out, it would have been more painful and lasted longer than anyone wants it to. But it probably would have brought about some, I say, healing maybe in the economy that needed to happen. But instead, the Band-Aid came on. And when the Band-Aid comes on, it helps patch things for a short period of time, but it hasn't dealt with the big stuff. And the bottom line is the big stuff is still there. And as long as the big stuff is still there, it's an issue. And the longer you wait, the more infected that wound gets. And I mean, I feel like those illustrations help me a lot. I don't know if they help anyone else or not, but that's kind of where I feel like we are. It's like, well, there's still no real way to avoid the pain.
No, I'll finish with this analogy that I used several years ago. I don't know if I probably stole it for somebody, but it's the best one out there, which is the athlete that instead of working out in the gym and training for a sport is taking steroids. And if the U.S. economy is the athlete, instead of working through the physical reforms and that would be the working out in the gym, getting prepared, and strengthening from the bottom up, we've been taking steroids for 8 years. And so the economy has not recovered the way it would have if we hadn't had both of those two working together. I think the Fed has continued to stimulate the economy with monetary policy when it blames Congress for all, you guys haven't done enough you haven't done, your half, so to speak. But in part, they haven't done their half because the Fed's made it very easy for them not to. Markets look great. I mean, if you're, hey, the stock market's a new all-time highs. Something's going right.
Right.
But that just doesn't seem to be the case to me. So,
well, we'll do this. Like, I think just for our audience sake and stuff, like, hopefully if nothing else we can take away from this, I mean, I think, Lawrence, you've given some really great ideas as far as how you're positioning yourself a little bit and some mindsets, which I hopefully will be helpful for our audience. But if nothing else, I want the audience to hear that if you have these concerns, you're not crazy, because it's easy to think that you're crazy.
That's why I write, because I'm trying. I mean, I literally enjoy writing, but I read a 1 week weekly piece on the economy to separate myself from the market and just to look at the statistics that are look at the data and say, hey, are things getting better? And I'm not trying to promote a certain opinion in those weeklies. I'm saying, hey, here's what we've got. Is this getting better, or is it getting worse, or is it unchanged? And then go off and talk about the markets in a different piece, because I would love to see things turn around from a fundamental standpoint and validate or work towards validating the valuations we have today. But I think we're a ways from there. So,
right. Well, Lawrence, it's been a pleasure to have you on today. Thanks so much for your time.
Thanks, Brian.
Well, I hope you enjoyed today's interview with Lawrence Fuller. Remember, you can get full show notes with links and other details at investorinthefamily.com. And don't forget to check out Brett Jensen's Biotech Forum at biotechforumsa.com. That's biotechforumsa.com. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.